How high income earners legally reduce their tax burden to zero. If your income keeps going up, but your tax bill never seems to drop, you're not just unlucky. You most likely are playing the tax game the hard way. Because right now, there are more high income earners doing everything right on paper, clean tax returns, solid CPAs, strong income growth, and still watching a painful percentage of their money leave every single year. Meanwhile, some of the world's most well-known founders operate very differently. In certain periods, leaders like Elon Musk, Jeff Bezos have shown surprisingly low taxable income relative to their massive net worth. Not because they stopped building wealth and not because anything unusual was happening, but because they understand one structural shift in the tax system that most high earners never fully examine. And once you see how that shift works, it starts to change how you look at income and taxes altogether. But to make sense of it, we need to start with one simple distinction and to see why this matters. Let's make it practical. Let's break it down. And if you're a high earner and about 40% of your income is going straight to taxes, that's roughly 4 to 5 months each year where your work is covering taxes first. And for many professionals, that's when the bigger questions start to surface, because in the next few minutes, we're going to talk about through the structural difference many sophisticated investors pay close attention to and why understanding it can change how you look at your income from here on out. Pain expansion. Picture this for a second. Someone earning well, staying busy, seeing their income climb year after year. On the surface, everything looks solid. The tax returns get filed cleanly, everything looks clean, and there are no warning letters from the IRS. But behind the scenes, something frustrating keeps happening. Every year, their income goes up, and every year, the tax bill follows right behind it. There's no breathing room, just more money coming in and more money going out. And that's where these smart professionals start asking a deeper question. Am I missing something? Or is this just how it works? What most people don't realize is the pressure often isn't coming from how much you earn. It's coming from how your income is structured on paper. The misunderstanding. And this is where many people were given advice that sounds right, but misses something important. Most of us grew up hearing a simple rule: make more money and you'll build more wealth. On the surface, that makes perfect sense, but the tax system doesn't treat every dollar the same. In fact, two people can grow their net worth by the same exact amount and still end up with very different tax outcomes. Not because anybody broke the rules and not because somebody discovered some hidden loophole. The real reason is simpler than that. The system draws a very clean line between two types of financial growth: earned income and asset growth. Once you've seen that line clearly, a lot of things begin to click, especially if you're a high W-2 earner who feels like your income keeps rising, but your tax bracket keeps rising right along with it. There's two different types of bucket shifts. To see why that keeps happening, it helps to look at this in a very simple way. Imagine two buckets. The first bucket is earned income. This includes salary, bonuses, consulting, revenue, or business income that flows directly to you. It's visible, it shows up quickly, and at higher levels, it can face federal rates up to 37% before state taxes even enter the picture. Very straightforward. Now, the second bucket works differently. This is asset growth, where wealth builds inside things like business equity, real estate, long-term investments. And here's the key distinction most high earners don't fully examine. In the US tax system, assets usually are not taxed simply because they increase in value. Taxes are typically triggered when the asset is sold. That one difference can create a very different long-term tax profile. And this is the point where most high earners start leaning in, because the obvious question begins: who is actually building wealth in bucket number 2? When you start looking closely at how well-known founders structure their compensation, a pattern begins to stand out. In certain periods, leaders like Elon Musk kept their cash salary relatively modest, while most of their net worth growth came from stock appreciation. That difference matters more than most people think, because salary usually is taxed when you earn it, but asset growth often follows a very different timeline. And to be clear, this isn't about doing anything extreme or unusual. It's about understanding how different types of financial growth are treated under the tax code. Once a high earner sees that clearly, their planning conversations tend to shift pretty quickly. And this is where the next layer of the conversation starts to get even more interesting. You may have heard this phrase before: Buy, borrow, die. It sounds dramatic, but the core idea is actually pretty straightforward. Step one is simple. You buy or you build the assets. This could be business equity, real estate, long-term investments that have the potential to grow over time. If those assets increase in value but aren't sold, there may be very little immediate taxable income. Step two is where most high earners pause. Borrow against the assets. Here's why this catches people off guard. If someone earns a $10 million salary, a large portion of that can become immediately taxable. If that same person holds appreciating assets and chooses to borrow against them instead of selling, the tax treatment can look very different because in most cases, loan proceeds are not treated as taxable income. To make this more concrete, large asset holders will sometimes access liquidity by using their holdings as collateral rather than triggering a sale. That's one reason you'll occasionally see headlines showing ultra wealthy individuals reporting relatively modest taxable income in certain years despite how massive their net worth growth is. Now, an important note, this area can become complex quickly, and not every approach fits every situation. But understanding this structural difference is often what opens many high earners' eyes, because once you see it clearly, you start asking much better questions about how your own income is positioned. When researchers have looked closely at this over the past decade, a clear pattern has started to emerge. If you measure strictly by taxable income, many top earners do in fact pay meaningful federal tax rates. But when analysts zoom out and compare taxes paid against total wealth growth, especially among the top fraction of households, the pictures can start to look very different. And that gap is where much of the public confusion begins. W-2 income is highly visible and immediately exposed to tax. Asset growth, on the other hand, tends to move on a slower and often more delayed tax timeline. So high earners who rely heavily on just one lane often feel that pressure build year after year, which brings us to the part that actually matters to you. None of this means the average professional should try to copy what the billionaires are doing. Everybody's situation is different. Income levels vary, risk comfort varies, and the right planning approach can look very different from one person to the next. But there is an important message sitting underneath this entire conversation. If most of your financial momentum lives inside highly taxed income streams, your overall tax picture can stay heavier than expected, even when your return looks perfectly clean. This is why sophisticated planning often starts with a different kind of question, not just how do I file correctly this year, but instead, how is my income positioned over the next 5 to 10 years? That shift is thinking where many experienced investors begin to notice new opportunities. And for many high earners, it's the moment they realize they may have been playing on the other side of the field the whole time. Now, just to be clear, this is for educational purposes only. It's not tax or financial advice. Every situation is different, and good planning always depends on the full picture. But if you're a high income earner and you've noticed your tax number barely moving year after year, it may be worth taking a closer look at how your income is actually structured. So if you want to go deeper, drop the word strategy in the comments or click the link in the bio for a one-on-one call with me. I'll share one framework that many experienced investors review when they start thinking more proactively about their taxes. And if this breakdown helped connect a few dots for you, make sure you're following alongside because we'll keep unpacking how high earners can think more strategically about building and protecting wealth.